to the Credit Suisse monthly economic outlook. After a long-awaited bid to tackle the debt crisis, European policymakers have laid down an agreement that aims to restore confidence and address tensions in financial markets. The agreement includes shoring up European banks, restructuring Greece's debt, and beefing up the firepower of the Financial Stability Fund. But despite this positive step forward, critical questions are still open, and financial markets will likely remain vulnerable until the specifics are answered. So, are we on the road to recovery in the Eurozone? With us today to shed light on just that is Joe Prendergast, Head of Currency, Commodity and Alternative Investments Research and a member of the Credit Suisse Investment Committee. Joe, Financial Stability Fund, haircuts, banking recapitalisation, what does all of this mean for us?
Well, these are all terms, of course, we've heard quite a few times in the last 2 years. We've actually had more than a dozen summits of various types now focusing on the euro area's problems. And I think on all these issues, whether it be haircuts, meaning reduction of the amount of outstanding Greek debt, recapitalizations, which of course help the banks themselves to deal with the losses represented by those haircuts, and the whole issue is referring to the sustainability of debt in Europe. We did get at least agreement in principle on a lot of these issues at this summit. We didn't, of course, get a lot of detail. There's still a lot of things to be sorted out in terms of how exactly all of this will work. But what we did get was at least a constructive outcome. And I think you can see in the market's reaction, there was a lot of defensive positioning ahead of this summit, a lot of fear, and I think those fears have been allayed.
What are those areas that are lacking detail that you mentioned?
Well, I think the principal ones are, of course, first of all, exactly how the European Financial Stability Fund will work in its new form. This really has a lot of detail yet to be worked out. There is agreement in principle that we'll use some form of leverage, which I think has been proposed, of course, in the past. And we didn't get a lot more detail on that. That still needs to be worked out. That's extremely important. The other thing is the bank recapitalizations. We got an idea of the scale, about 106 billion or so in recapitalization, but we don't know exactly where these funds will come from and how that will be implemented, and that's of course very important. And finally, of course, we have a lot of proposals on the individual country side. This is really a very important part of this summit in particular. We saw a focus on what the national governments broadly need to do, not just Greece, but broadly. And of course, we had some quite specific proposals, but we also need to see now the exact implementation. How will this be done? So this isn't the last we will hear of these issues, but we did at least get good agreement in principle.
You recently participated in the Global Economic and Strategy Group meeting, where I'm sure the euro crisis was high on the agenda. Given the prevailing risks, what strategies should investors be focusing on now?
Well, I think the strategies that we focus on right now, of course, are a balance between a still, in our view, positive strategic outlook on the equity market and the uncertainties that we still face. We shouldn't make the mistake to think that Europe has just resolved all its issues. Of course it has not. We will be revisiting almost all of these issues in the not too distant future. So we need to be somewhat cautious still on the tactical outlook. We would be quite neutral as far as the tactical outlook on equities is concerned. But you are seeing at the same time really good economic data and good earnings data underpinning still a positive strategic viewpoint. Maybe where there'll be more potential still is perhaps in some of the credit markets related to the summit more directly. While government bonds are of course not likely to do well as a result, some of the credits, particularly perhaps senior bank debt, will I think do very well as a result of this meeting.
The announcement of this agreement saw the euro rise against the dollar. Has confidence in the euro and the eurozone been restored, and should we be buying euros now?
Well, I think the euro has recovered primarily in response because people were very defensively positioned beforehand, even using the euro as something of a hedge against bad possible outcomes from the summit, etc. So the reaction is partly just a squeeze of that defensive positioning. I think there's something else also going on, though, because we have to remember the euro has really dramatically outperformed expectations. This does not look like a currency on the verge of existence. Its level versus the dollar is actually still quite strong. And part of the reason for that, at least, is the fact that you do have a process of deleveraging going on in Europe, but it's not so much disorderly, forced deleveraging. It's just flow of capital at the margin back to the European banking system as risk is marginally reduced. And that, of course, as long as global markets are generally stable, is something of a euro positive, and it's something the market's not really focused very much on. That's underpinning the euro. So too, of course, the return of some discussion of QE3 by the Federal Reserve in the US. That's, of course, a big topic if that were to be the case, undermining the dollar potentially. But really, I think the balance of forces in euro-dollar is still quite neutral. We've said for a long time it's a range either side of 140. We still think that is the case. Probably in emerging markets where you've seen significant sell-offs also prior to the summit, there is maybe more potential for durable gains, particularly in the context of a Federal Reserve which is staying very, very easy.
The last couple of months have been pretty turbulent for commodity prices. Can commodity markets focus on the fundamental supply and demand dynamics again?
Yes, I think they can. I think commodities, of course, have also seen some significant deleveraging in the risk aversion that we have seen. We've also had something of a slower patch of global growth through the summer months, and that has, of course, undermined commodity prices. Now that we're in a little bit of a better patch for most recent economic data and risk aversion has receded a little bit, I think commodities are individually returning to look at their own supply-demand situations. And that, of course, it depends on exactly which market we think about, but in general, this is much more constructive for commodity prices.
Where do you see the biggest potential moves then in commodity markets?
Well, I think the precious metals space is still really the most interesting. We have central banks staying very, very easy. We have real interest rates staying extremely low. That's really going to stay positive for gold, and we also think platinum. Both prices, in our opinion, heading in the direction of $2,000 an ounce into 2012. I think the industrial metals as well, which of course would be benefitors of any return to an upswing in the global economy, can also do well, particularly nickel and copper, in fact, where you have a supply-demand situation which is also conducive to underpinning prices.
Thank you, Joe. That was Joe Prendergast, Head of Currency, Commodity and Alternative Investment Research at Credit Suisse. For more information on current market conditions or for investment ideas, visit the website creditsuisse.com/markets or check out the online magazine In Focus.